In 2008, the world faced the worst financial disaster since the Great Depression. Banks collapsed, millions of people lost their homes, and entire economies went into shock. But what really happened? Why did everything fall apart? And how did a crisis in America shake the entire world? Today I'll explain the 2008 financial crisis in the simplest possible way. Our story begins in the early 2000s. The United States was experiencing a housing boom. Almost everyone wanted to buy a house, and banks were encouraging it. Interest rates were low, loans were easy to get, and people believed that house prices would rise forever. The idea was simple. Buy a house now, sell it later for a profit. This thinking became very common. Banks took advantage of this moment. They started giving home loans to almost anyone, people with low income, weak credit history, and even those who had no stable job. These risky loans were called subprime mortgages. Normally, banks would avoid such customers, but this time they didn't care. Why? Because they weren't planning to keep the loans. Here is where it gets interesting. Banks started bundling thousands of these home loans together and converting them into a new financial product called mortgage-backed securities. Then they sold these products to investors around the world, pension funds, insurance companies, even foreign banks. Everyone believed these investments were safe because they were based on house mortgages, and historically, house prices almost never fell. But there was a big problem hiding beneath the surface. Many of the people who took loans simply couldn't afford them. Banks never checked carefully. They assumed, even if they can't pay, we can take their house and sell it for a profit. This was a dangerous assumption. By 2006, something changed. House prices stopped rising. Then they started falling. Suddenly, people realized the truth. They couldn't afford their loans, couldn't sell their homes, and couldn't refinance. One by one, people began defaulting on their mortgages. When millions of people stopped paying, the mortgage-backed securities that banks had sold to investors started losing value. What was supposed to be a safe investment became worthless overnight. Investors panicked, banks panicked, but the worst was yet to come. One of the biggest investment banks in the world, Lehman Brothers, had billions of dollars tied to these bad loans. When the truth came out, nobody wanted to do business with them. On September 15, 2008, Lehman Brothers collapsed and filed for bankruptcy. It was the largest bankruptcy in US history. When Lehman fell, the entire global financial system shook. Other banks were holding the same type of bad investments. No one trusted anyone anymore. Banks stopped lending to each other. Businesses couldn't borrow money. Companies started shutting down factories. Millions of people lost their jobs. The stock market crashed. It felt like the world economy was freezing. Governments rushed to take action. The US government created a huge rescue plan, giving billions of dollars to banks to keep them alive. Central banks lowered interest rates and pumped money into the economy. Slowly, confidence began to return. But recovery took years. So what caused the crisis? In simple words, greed, bad lending, and the belief that house prices would always go up. Banks took too many risks. Rating agencies gave high ratings to dangerous investments. Investors didn't ask questions, and millions of people signed loans they couldn't afford. It was a chain reaction of mistakes. But the biggest lesson from the 2008 crisis is this. When one part of the financial system collapses, the whole system can crash. Everything is connected. Banks, businesses, investors, and ordinary people. A mistake made in one country can affect people across the globe. The 2008 crisis changed the way the world sees finance. New laws were introduced. Banks were forced to be more careful. Governments realized how fragile the global system is. And millions of families who lost their homes learned a painful lesson about risky borrowing. Today, more than a decade later, people still talk about the 2008 financial crisis because it wasn't just an economic event. It was a wake-up call. A reminder that unchecked greed can destroy economies, companies, and lives. If you want more simplified stories about financial history, make sure to like this video, subscribe to the channel, and comment which event or company you want me to explain next.